trying to say y'all are lying about your mortgage payments, but I need some like clarity. I'm gonna put some photos right here. I'm on the mortgage side of TikTok. I'm I guess on the wrong side because I can never afford this. Mortgage, $5,300. I'm gonna post all the pictures right here. Mortgage, $2,919. Mortgage, $5,073. I have to recheck. Hold on. I just went back and rewatched those videos. $5,000 for mortgage? Okay, people clap at me like, oh, you chose a camper. Heck yeah! How are y'all... Okay, how are y'all affording mortgage?
We are once again on the cusp of mortgage rates falling and staying below 6%, which is the first time in over a year. But the really, really important big question is, will they stay below 6% this time? And are rates dropping into the 5% enough to even save the housing market from complete and utter destruction? Probably not, but today we're going to help answer that question. And welcome back to Real Estate Mindset. You guys already know this video is going to be absolutely bonkers. Starting with the 10-year Treasury, which is what we monitor to track residential mortgage rates. Now, very interesting thing is on Thursday, or October 16th, the 10-year did close under 4%, closing at 3.973%. Now, the next day on Friday, as you guys see here, it got back over 4% once again. Now, when we look at the chart of the 10-year over the last 3 years, there's only a few times where the 10-year went under 4%. One time was August through September, so about a 2-month period, and then it shot back up. Another time was here at the end of 2023, and this was about a 2-week period in December of 2023. Now, prior to that was around July of 2023, but before July of 2023, remember you guys, this time period right here, this was the bank bailout of 2023 when we had several different bank runs. So it is going down, it has gone down, but the real question here is, are there enough people that trust the 10-year Treasury to purchase it so that those rates go down? Personally, I don't think so. But let's look at residential mortgage rates. Again, closing finally under 6%, at least for FHA. As you guys see there, FHA, I highlighted 5.99%. Remember, FHA has lower interest rates, normally a lower down payment. Generally, it's much easier to qualify for. But when we look at conventional mortgage at a 6.23%, remember, typically the only mathematical reason a conventional mortgage is better potentially is sometimes mortgage insurance goes away, which is called PMI. So private mortgage insurance sometimes goes away, but regardless, that's at 6.23% right now. Before going into our next segment where we're going to look at amortization and we're going to look at a payment calculator, because if you want owning a home to be better than renting, you have to choose to make it that way. If you just keep your head in the sand, it's not going to be good. So before we go into that, I want to listen to this man right here who has just decided to refinance all of his consumer debt into his house. And Mitch, I want to get your thoughts on this at the end before moving on to our next segment.
So I took a $127.5 thousand home equity loan out on my house. You may be wondering, why would I take money out of my house? Oh my God, it's a appreciating asset. So I want to show you guys a visual on my idea, right? So right now we're paying over almost $670 a month for this, $930 a month for that, $220 a month for the camper, $1,380 a month for the house, plus $300 and something a month for the roof, right? So the $127,000 loan is paying off the roof, it's paying off the Durango, it's paying off the truck. It paid off a $19,000 personal loan that I had out for quite a few reasons. So we're dwindling over $4,000 a month in bills down to roughly $2,500. In turn, the only bill I'll have left is the camper and the house. Now, if I travel this winter, which you guys will get to see, I'm gonna pay this whole thing off. I owe like $21,000, $22,000 on it. I plan on paying that off this year. I don't owe any money on those. I don't owe on anything in the house. We're growing out of this house because we have 2 kids. It's a 2-bedroom house. Yes, I could add on to it, but honestly, I want more land. So I'm kind of addicted to barndominium TikTok right now. And in my area, you could find 20, 40, 60, 80 acres and build on it. So in about a year or two, hopefully a year, depends on how much I travel this year, I want to buy land, sell the house. I'll have zero debt, maybe a little bit of overflow on, whatever, because we only took out 85% of the equity. And then we're going to build our dream house, which is going to be a version of a barndominium. And maybe my wife will get horses.
Mitch, I'm going to be honest with you, sir. It's really, really hard for me to hold back my opinions. I just want to throw something out there just real quick, just in case you don't touch on it. Why would you refinance your house if you're about to sell it? Okay, that's all I wanted to say. The fees are astronomical. He doesn't look like he's making good decisions. But what are your thoughts on the video you just watched?
Well, before we get to that, let's talk about the young lady at the very beginning that you showed. Just to be clear, $5,000 a month is the equivalent of an $850,000 loan. So she has a point. Over and above that, with regard to this person, he's not paying off anything. Let's be real clear here. What he's doing is he's swapping one debt for another. He's wrong. And the only way that he could possibly be right is if the loans that he had on the vehicles were paid off within the same time frame, net cost difference, zero, except for the interest. The problem is when he swapped from a 5-year loan roughly to a 30-year loan. The interest will outstrip any of the savings that he thinks he has, guaranteed. So the reality is he's probably got a 30-year AM on the house. He swapped 5-year debt for a 30-year AM. The interest will eat him alive. And the idea, well, we're going to sell it in the future. Okay, unless he's Nostradamus and can tell exactly what the economy is going to be like in his immediate neighborhood. Yeah, no, he's not. It's delusional. And people should not be swapping what is a quantified debt for something in the future based on some idea that you think is going to happen. It's just economic suicide. It makes no sense.
Yeah, and on top of that, he's saying he can pay off his camper. Well, then why not just pay off the camper and then start paying off the other debt? Because again, the fees, and you just hit on the interest, which brings us to the next really, really super important aspect of this video. If you're going to purchase a home, and we're not saying you should, but if you are in the worst time in history to do it, and you want it to make more sense mathematically than renting, because right now it's a slam dunk to rent. So if you want it to be better than renting, you must pay the loan off early. Let me show you. Taking a look under the hood at an amortization schedule. This is how you guys become successful and hopefully a more debt-free life. You have to pay this off early. Now I'm taking a $500,000 loan over 30 years and I'm using a 5.99% interest rate, even though conventional is not that low. And as you guys can see, immediately on a $500,000 loan, you're going to pay back a total amount of $1 million, a little bit over $1 million. Now I show you that because it's okay to rent for a while. Yes, we do want to own. We do. Owning the roof over our head and owning the shelter we live in is generally a really good thing and the American dream. But right now, it's super dangerous. In fact, when we look at the first year and we compare the first year, which is highlighted here, when we compare the first year to the last year, it's going to blow your mind. Now, I've highlighted in red the interest cost over the first year of the amortization schedule, and I've highlighted in greenish, I guess that's a greenish, on how much money goes towards principal. So the first year, $29,000 goes towards interest and only $6,100 goes towards principal. But when we look at the very last year, year 30, the amount of money that goes towards interest drops significantly to only $1,100, whereas the principal goes to $34,000. And the reason that is amortization schedules are a huge ripoff. In fact, it's not until year 19 that you pay more money towards your principal, which is $18,000, than you do towards your interest, which is $17,900. So if you don't want to wait till 19 years to start paying down more principal than interest, all you have to do, it's really easy, guys, is you make an extra monthly payment and just say it's like $300. Okay, say you're going to cancel some subscriptions. I know you can. Okay, we're going to do an extra $300 a month. Let's calculate this and let's figure out how much money we're going to save together. Well, there it is, $140,000. in just interest, and you've taken the loan from a 30-year loan and now you've turned it into a 23-year loan, only you're not locked into that payment. You can literally, if you have to skip 1 or 2 months, you could do that and re-up next month. The thing that I'm trying to explain is this is very dangerous. The banks get filthy rich off of the video that we just watched, like that, people that spend like that, plus the amortization schedule. Please don't just jump in the refinance market and decide to refinance your mortgage. It is super duper bad. Now, when we look at the actual payment, how is a mortgage payment even created? We take a $550,000 house, you guys see here, 10% down payment, 30-year loan, interest rate of 6.26. We calculate the payment based on 2% tax, $3,800 in homeowners insurance, 0.55% in PMI, so conventional mortgage. We get a total payment of $4,500. But the thing I want you guys to understand, first of all, we looked at the mortgage payment. Okay, that's $1 million. But look at the property taxes over 30 years and home insurance over 30 years. The total of those two things combined equals almost the cost of your house. So again, over 30 years, and actually for my house, it's worse than that because my tax rate's a lot higher. But if your tax rate's only 2% and your homeowner's insurance is $3,800 a year, in 30 years, you pay almost as much in those two things than you do versus the entire purchase price of your house. And I'm saying that because remember, homeowners insurance and property tax never goes away and goes up with the equity of your house. So if your home value goes up, so do those other things. And to prove my point, let's listen to this homeowner who continues to have shortages in her escrow account because property tax and homeowners insurance is skyrocketing and the lender can't keep up with those expenses.
I'm 2 seconds away from selling my house. Why is my escrow always short? Why? Yeah, when I closed on my house, my new bill, it was in 2020, it was $1,296 when I closed on it. Hallelujah, praise God. 4-bedroom, 2-bath. Okay, stay with me because I'm about to put you in my business. When I closed on it, it was $1,296. What they don't tell you in the new bill, the property tax is just a guesstimate. It's an estimate on what they think that property tax is going to be, okay? The next year, my mortgage went up to $2,800. Why? Because your escrow was short $10,000, Miss Mallet. They said, don't worry about it, Miss Mallet. We got you. We're going to pay that shortage for you. Oh, you doing like y'all doing me a favor. Well, what y'all do with the money I just paid? What did y'all do? That's when I found out it was just an estimate, okay? I paid that $2,800 twice. I said, that's not feasible. It ain't. I'm a one-income household, so I gave them that money. So I'm thinking my mortgage is going to go back down to $1,296. No, it didn't. It went to like $1,500. Okay, boom. I pay a little extra because I learned that year. I pay a little extra, but what I didn't learn was when you have an overage, when I had an overage the following year, take that money out. Do better than me because I'm a teacher out. Take that money and put it back in your escrow account, okay? Put it back in your escrow. What I do with it, I spent it. Don't you do that, okay? Do better than me. Fast forward. I'm short again, $2,000. I said, I'm not paying that $2,000. They could just put it on my mortgage. My mortgage went up to $1,700. Okay, boom, I'm paying it. Why didn't folks just send me another email this year? How about we just did a new report? Your mortgage is going up to $3,000. I mean, you short $3,700. Your mortgage going to go up to $2,000. Pay it by November the 1st. Who looking to buy a house for $2.50? Let me know.
Mitch, obviously it's vital to make good decisions when purchasing a house. I mean, it's a once in a lifetime decision for most people. Can you respond to that video and maybe talk about how expectations and understanding how escrow is important?
It sounds to me like she's got some sort of built-in defeasance in the mortgage plus fees. So by virtue of the fact that she didn't make the payments, they hit her with a penalty and said, oh, don't worry about it. We'll defease it towards the back end. But in the meantime, the debt didn't go anywhere. They added on to the debt. And then they added, it sounds like they added on fees on top of it. So the compound cumulative effect is now she's paying more money on a monthly basis and doesn't seem to have control as to what's really going on. I don't know that that is what's in her mortgage, but that is what it sounds like.
Would you say if someone's going to buy a new home, it's important to get correct escrow coverage so that you're not hit with a $10,000 bill or a $5,000 bill like a lot of homeowners are receiving that purchase new homes?
I would say it's important to read your homeowners association documents. It's important to read your agreement of purchase and sale. It's important to read your mortgage, especially if you're buying from a new home builder on a new home loan where you have arbitration which is a one-way ticket into hell if something goes wrong. And it is best to truly understand the amortization schedule. With those 4 things accomplished, you're in good shape. Don't accomplish them, you're just setting yourself up for failure.
Yes, sir. And speaking of something setting itself up for failure, let's look at the housing market. I'm going to show you guys how unaffordable the housing market really is. And I'm also going to show you that the people that are propping up the housing market are really the people that are well off using cash. And they're not even barely propping it up, but 29% of U.S. home purchases are made in cash, which is essentially flat from a year ago because they also propped it up last year. Now, when we look at the share of homes bought in cash, essentially being unchanged, look at this, guys. Pretty much ever since we got out of lockdowns, it's been going up and it's been staying up. Mortgages don't even make sense. And you also see that in the median down payment that is essentially hitting a record high. In 2019, the down payment average is about $28,000. Now it's $70,000. I mean, we're getting bamboozled with inflation right now. Most people don't have an extra $70,000 plus making $1,500 extra a month on the mortgage, plus having money in our savings account just to afford the cost to keep up our houses. But again, you guys, down payment 19%. Prior to that, it was about 10%. Look at 2019, 10% down payment. So it doubles. People can't afford to buy a house. When looking at Redfin's most recent weekly housing market update, we now have, according to their data, I hate using their data, but we have 12 metros on the year-over-year decline list, which is Austin, Dallas, Atlanta, Jacksonville, and Fort Lauderdale leading the way. Usual suspects, but we also have metros that are still going up in value because there are still some people propping it up, and there are still some housing markets when compared to the rest of the housing markets that are more affordable, even though essentially when we look at fundamentals, when we look at historical precedent, no housing market is affordable. But Cleveland is leading the way, up 12%, Detroit up 8.9%, Providence, Rhode Island 7.2%, Anaheim up here again, crazy, 6.4%, and Warren up 6.4% as well. When we look under the hood and we look at the median sales price, again, I think that the median sales price is still going up because the data is cooked and the upper end of the median is still purchasing houses, whereas you and I, the lower end of the median, we can't even afford to purchase a house. Or if we can afford it, we're smart enough to know we shouldn't. And that's what I'm doing on the sideline. Median sales price, again, is saying up 1.9% year over year. But I want you to remember when we start the year 2026, 2022 is going to go away. Remember, we need to be well under where we were in 2023, which means we need median sales prices around 350,000, maybe slightly higher. When we keep going down this list, one thing that is not changing is home buying housing payments. It's up a 1.1% year over year. You see that right here, sitting at about $2,564. I want you to remember, again, looking at 2022, before we got into this mess, the average mortgage payment was under $1,750. So they're up now about $1,000 per month. Now, pending sales are still down. So all this hoopla, pending sales are down 1% year over year. I mean, the housing market's literally in a dumpster fire, and these companies and these regional banks are barely hanging on. New listings are up 4% year over year. Active listings are also up 7.5% year over year, sitting at 1.2 million. Active listings, supply is also up year over year, sitting at 4.5 months of supply. We haven't had this much supply in years in the housing market. Remember, you guys, supply is demand into inventory. Lastly, Redfin home buying demand is down, all right? Year over year, think about it, double digits, 10%. And you got to stop and think, like, how is it down 10% year over year when the last 3 years have been absolute worst housing market in history? And the reason that is because the housing market continues to collapse and inflation continues to make it worse. Before ending our report, I want to listen to this video because this young man brings up a good point. Is it morally irresponsible to price out local residents?
Am I the only one that thinks that it is morally wrong to move from like other areas like California or Washington State, move to cheaper areas like my home state, Ohio, and start buying up all of the houses and properties and pricing out the locals? I was on my For You page and there was this 19-year-old that moved to Cleveland, Ohio, and was honest, like being honest about why he moved to Cleveland is about how he wanted to buy up all of these properties in Cleveland and be a landlord basically, and pretty much price people out of their own neighborhood. And I feel like there should be laws with this. I think like in this day and age, like that's so morally wrong. And the fact that this like 19-year-old is just being like so free and open about it, like you have to be a pretty tough person to do like that. Like be a part of the solution, not the problem. Like you are the problem of why people are being priced out of their neighborhoods. And I didn't really realize this until I moved to Tennessee, but it has happened so bad in the state of Tennessee where a lot of people from California have moved here. Not only moved here, but they've invested, bought up a lot of the properties, and people can't even afford their own city anymore because they can't afford to buy a house because they're all owned by investors and big corporations. And I just don't understand like why people continue to do this. It's a monopoly, and you're messing with people's like homes, you know, their hometowns. And I think this is slowly going to become a reality in Ohio. And I think people in Ohio are a little too nice and are being a little too friendly to people like this. I was like looking at this guy's comments and his videos, and everyone was so nice. They were like, oh, you should check out this and this. If you do that in Tennessee and say that you're buying up properties in Tennessee, everyone in Tennessee is like, go back to California. Don't California my Tennessee. Like, that's how Ohio people should be. Like, it should... Like, I just don't understand, like, any of that. Like, it is morally wrong to price people out of their hometowns, I guess.
Mitch, he's got some fair points. He's got some fair points, but he doesn't mention the root of the problem, which is the Federal Reserve, property taxes, fraud, greed, corruption, apathy, all those things. What do you have to say to him? And if you can, give us your final thought on this video.
The average median household income in the United States, which means across the United States of America, is $81,600. That requires a maximum, I'm going to underline the word maximum, house value of $271,000. That's based on a 28 DTI. Now, anybody that does that is going to be extremely uncomfortable because they will be barely able to afford that value of a house. The real number is somewhere between 21 and 23, which would be a max house at $200,000. On my website, you can do a word search for homeaffordability.pdf. It'll come up. That document is also inside of the presentation called the Amicus brief that was given to the Supreme Court of Texas. That lays out the math as to what the home affordability actually is in Texas, and the math is applicable anywhere in the United States. So this gentleman is wrong. Now, he's speaking from his heart, but without the math and the statistics behind him. So the real estate tax is what the issue is here. And the real estate tax is a fraud. And we are very familiar with what's going on in Ohio, which is basically the Wild West of bonds. In Ohio, the law is such that you, the school district, can do whatever you can get away with. There is no governor on what they can do in terms of the bond raise versus the state of Texas, which is ignored. But at least in the state of Texas, they do have a 25% governor on the prior year's outstanding amount of bonds. In Ohio, no such thing. So if you leave the market to its normal circumstances, none of this would be happening. As far as the idiot that is coming in from California and bragging, this 19-year-old, well, I'm going to buy up everything and I'm going to jack the prices. No, he's not. He's more than likely to go bankrupt. Why? Because Ohio, just like everywhere else, has a median household income. And I don't like to be quoting gross median household incomes across the United States because real estate is all local. You can have pockets where there's 150,000 median household income. But the point of the matter is it doesn't matter. The only thing that matters is the median household income. Anything above that in terms of the expenses, de facto, is a creation of fraud. Your school districts have created bond fraud. Your school districts are bankrupt. There is no math, right? You cannot get blood out of a stone. Mom and pop cannot pay what they do not have. That is anything over and above the ability to afford the roof over their head. That's it. And if they don't have it, de facto, anybody that's claiming by virtue of the bonds, well, we're going to get it paid off in the future by mom and pop, you're lying. You're a criminal. It's that simple. You violated your oath of office. You violated all the documentation with regard to what's necessary to raise bonds. Other people have supported you. There's no doubt about it. But the fact of the matter is it doesn't change the underlying fact. The money does not exist to pay this off. This is what this fellow should be focused on, which is go to your school districts, start getting involved in the local issues at those school districts, at your central appraisal districts, and start asking the appropriate question. Given the median household income in your Ohio location, in your district, how exactly are you, the board of this school district, going to get these bonds paid off? They won't answer your question. Therein lies your problem.
And he's talking about local debt, right, guys? So when you purchase a house, figuring out what's happening with local debt is really important because it drastically impacts your property taxes. So another important thing for those median households, talking about median household income, those households, another important thing is those households make smart decisions. Don't use your credit cards. Don't use buy now, pay later loans. Don't buy a brand new vehicle. Buckle down. And hopefully on the other end of this thing, on the other side of this recession, and when we go through it, you guys can start making money again. And we can start living happy and healthy lives once again. Do me a favor, guys. Comment below. Don't forget to share this. Happy Monday morning early. Let us know. Did you guys see any of those No Kings protests in your neighborhood? I did about a mile from my house. There was no King protests. Just interested, not taking any sides here, but I'm interested to hear from you. I love you guys. You're so important. Have a great Monday. And if you're out there investing in real estate, you guys already know we wish you luck. And we hope you win.